Welcome back to the Personal Finance Project. I'm joined once again with, it's just Scott and me today. Today we're doing another segment on the things that you pretend to know, and Scott and I are going to pick apart your primary residence as an investment. I think most people are under the impression that their home is a very good investment, and Scott and I are going to have some thoughts on that matter. So to get us started, Scott, how do people typically think about the return on their home?
Well, you can disagree with me, but I would say that most people think I bought this house in 2015 for $300,000. I've got a mortgage of $200,000 left on it, and I think I could sell it for $350,000 today or $400,000 today. So my return is the delta between those two numbers. It's between what's left on the mortgage and what I think I could sell it for.
Yeah. And I think that this is the way most people love to view it, because when you do that little bit of arithmetic, if you've owned your house for a sufficient length of time, it leaves you with this number that is reassuringly large.
Yeah.
You know, so you feel like, wow, that strikes me as a really good investment. But what most people fail to do is you have this number, and that number isn't even a holding period return. I suppose some people do the division and they say, look at this. I put in this amount. We cleared this amount on the mortgage. If we do a little bit of division here, that tells us we got this X amount percentage return. And that would be your holding period return. Virtually nobody then annualizes that.
Yes.
And so when you and I discuss, or when we're sitting down with a client and we're showing them how their investments, like within their portfolios, have performed, we're always presenting those in terms of this is your annualized rate of return.
Yes, we're not really looking at it in terms of, I mean, it's nice to track every once in a while. You started with this, you spent this, the portfolio has therefore produced X as a nice big round number. But then in the background, what we're usually doing is saying, okay, that means 6.4% or whatever the annualized number is that you get to over that time period.
And I think when people quote kind of what the S&P 500 has done, they're always quoting in what it has compounded at over time.
Yes.
And because that gives you the best indication of if you put $1 into the S&P 500 in 1950 or 1960, what that dollar might be worth today would rely exclusively on what that compound annual rate of growth is. So,
and I think to just add on to this for the mortgage, or just the home value calculation, I think a lot of people, the longer you've been in a house, also what happens is we tend to think in simple interest as opposed to compound interest. So you don't really go, even if you say, okay, it's up 100% over 10 years, that's not a 10% compounded rate of return. It's a 10% simple rate of return.
And I think like an example that I drew from a previous discussion that we'd had is if you bought a house 30 years ago for $50,000 and you sold it today for $900,000, your brain just immediately hears the difference between those numbers and thinks that must have been a phenomenal investment. I mean, the rate of growth on that is probably something I couldn't even calculate, but with the help of a 10B2 plus, you discover that
That's a calculator, by the way.
It's a financial calculator. You discover that in this, very simple example, and we'll get into some of the particulars here in a second, that equates to about a 10% annualized rate of growth. And
which is nice.
Which is great. I mean, that is great, but is it like so much better than you could have done in just in a broad market index? No,
it's not so much better. It's probably a little bit better.
Yeah.
And I think we'll get into this. There's some comforting things about homeownership and the investment return.
Yeah.
And we'll touch on those a little bit later, but a couple of them are that houses are not marked to the market. You know, you don't get a report on your Baird Online every single day how much your house is worth.
Right.
So it could go down by 10% in a year, and you might feel it just in the economy being a little bit uncomfortable, but you're not going to get told by the mortgage company, hey, your house is worth $80,000 less than it was.
Yeah, and then on that note too, because there are services now like Zillow, which will give you kind of a daily. They don't update it daily, but they update it periodically, probably a little bit more than say quarterly. But what I would argue too is there's something about a market price for a stock that we take at immediate face value. But if say Zillow were to report what they thought your house was worth, you're probably like, yeah, but the idiosyncrasies of the process of selling a home to a willing buyer are such that I don't really take that estimated value that seriously. You know what I mean?
Yeah, I know what you mean.
And we don't do the same thing with stocks or bonds. We're not like, yeah, well, if I found Joe on the street, I could probably get him to go on my Apple stock for this much. Like, we're pretty sure that the market is accurately reporting the price of a stock, but we're very uneasy about just saying, hey, this is what we think your house is worth. Even if you got it appraised, you might think, well, that doesn't really tell the whole story of my house.
Yeah, because there's so many things that are going on in the background of a real estate transaction. Like, what are the commissions and
Uh-huh.
who's paying them? And so, I mean, say you're selling a house that you bought for a very small amount of money, the commissions that are going to be paid to both real estate agents, those are not based on the original purchase. You
No.
can't do NUA on an old house for the
Yeah.
commissions. So
Yeah, and I think that's a great jumping off point for us start to pick apart this very simple example of I bought my house for this much. I think it's worth this much. I have this much left on my mortgage, so therefore I earned this chunk of money. And one thing that people tend to overlook is there are going to be annual upkeep costs on a home. And there's a lot of ways that you can figure this, but most estimates range somewhere between 1% and 3% of the value of the home. So not to confuse that with the balance of the mortgage, but the value of the home. So very simple. You have a $100,000 house. For every $100,000 in value that your house goes up, you're paying an additional $1,000 to $3,000 a year in maintenance costs. Critically, those are not added to your basis in the property.
yes.
So, and even more critically, nobody really is counting those as part of the investment that they've made in their home. Admittedly, I don't do it.
Yeah, I don't either. And just to clarify, this is in addition to property tax,
This
right?
is just maintenance costs.
Okay.
So this is just roof, gutter, windows, plumbing, whatever goes wrong.
Yeah.
4 boys that are destructive. Who knows?
Hurricane that
Hurricane.
comes through Houston.
Yeah, it's like
Yeah.
just the basic maintenance costs of the home tend to range between 1 and 3% of the home's value. Now, newer homes probably on the lower end. Older or historic homes, those might be on the higher end, just
Yeah.
because the materials necessary to do the upkeep on those homes, not to mention how often they might break down, probably a little bit more frequently. So newer homes, those tend to do a little bit better. But still, if you have a pretty expensive house, I mean, you can really see how, and that's annually. That's not like a one-time deal. This is every single year you're paying, in some cases, thousands of dollars just to keep the home going.
Yeah, and that just right off the bat, that's probably taking your idealized 10% rate of return. And I'm setting aside just truly strange stuff here. Like, you buy a house in a place that just becomes the next location,
Yeah,
and it
yeah.
20x's really, really quickly. But normally, say like 10% is an aggressively positive long-term rate of return. This right now is already taking us down into probably the high 8s.
Yeah, so it's going to take a couple of points off the board here,
Yeah.
so to speak. And then, as you just alluded to, now we can get into mortgage interest that you're paying over time and just your real estate taxes. And one of the notes that you and I talked about here is I think people tend to overestimate the value of the tax deduction that they're getting associated with in maybe higher state income tax places or higher property tax places, and because we're based in Texas, the SALT deduction that they get and then the mortgage interest that they're paying. I think, as I in the outline noted, the great management guru Michael Scott once asked David Wallace if it would help for tax purposes if they spent a ton of money on something that they didn't otherwise need. And I think people really do make the same mistake with mortgage interest. They think, yeah, I do have a big mortgage, but I get a tax deduction. And it's like, well, the benefit of the tax deduction doesn't scale in proportion to the size of the mortgage. You're always getting the same benefit. You're always just getting, if you're in the top marginal rate, your deductions are only worth 37 cents on the dollar.
Well, and I think a lot of people are maybe stuck in 2014 with the way they think about this as well. Because the other thing that it used to be the case that you'd have your standard deduction and then your personal exemption, and these things were separate. Well, in the code changes that happened in 2017, those were combined into a much larger standard deduction. And so now you basically need to have property tax, mortgage interest, and charitable get over, if you're married, $32,000 before you even start to itemize. So we're talking about a pretty expensive house if the mortgage interest is having to carry the freight.
And then you're right, the so-called benefit being provided to you from a tax perspective is really only the excess in your itemized deductions above what you would have already taken in the standard.
Yeah. So I mean, I've had this happen before because I bought a house but I'm fairly young. I don't have huge liabilities and stuff. So I ended up with being able to itemize by $47 or
Right.
something
Yeah.
like that. And it's just not very useful.
No, and so I think again, one of the things I think the tax deductible nature of mortgage interest kind of obscures how costly that is in terms of home ownership. Because remember, you're really just servicing a debt on that. And yes, you get to essentially pay for it with pre-tax dollars, but the IRS is not they're not fooled by this. So you're not pulling the wool over anyone's eyes. They're essentially saying, yeah, you've not been made economically better off by this. This is an expenditure going out the door, and we're really only compensating you for the tax burden on that expenditure. That does not mean that higher expenditures mean that you've somehow pulled ahead in this economic game. It hasn't whatsoever. It doesn't mean that whatsoever.
Yeah, I totally agree with you on that.
And then the same story can really be said for the state and local taxes. It's just a different form of a deduction. Now, I would argue, though, if the cap on that has now gone up and you were itemizing already, like I was because of mortgage interest, incidentally, that I suppose is kind of a new benefit to people with the new SALT deduction going as high as $40,000 if you have adjusted gross income less than, I guess it's 500 or 600,000.
Yeah.
That I suppose is kind of a new benefit because this is a new deduction you weren't otherwise getting.
Yeah, no, I agree with you. And I think that is going to be more helpful for places that have a state income tax.
Yeah,
because
absolutely.
I think, and we did a little bit of math on this in the background, affording a home that produces enough mortgage interest to max it out in, say, Texas,
Right.
you're probably going to be above the income threshold
Yeah.
to be able to do it.
Yeah. So you're right. You would have to really the benefit would accrue to people who were paying these taxes but not getting the associated deduction. And now that deduction, that cap has been lifted. So that is a true tax benefit. But again, you're only made economically better off because now you're getting a deduction you wouldn't have otherwise gotten. That's not licensed to go out and pay more for a house than you otherwise should.
I mean, it's still money that is it's an outflow.
It's
from
leaving your
your
pocket.
personal cash flow report.
All right. And so maintenance costs, tax deductions, that kind of thing. Another thing that I feel like people tend to overestimate the value for a couple of reasons are renovations.
Oh,
So
yeah.
this could be adding a deck, redoing the windows, updating the kitchen, remodeling a bathroom,
The pool.
adding a pool. And one of the things too, I think it's especially true for my wife and I, because we're a little bit strange, is your tastes and preferences are probably more idiosyncratic than you think. So it's kind of like in the note I shared to you, no, honey, really, the man cave, it's going to add a lot of value when we resell the home. Probably not. Probably not.
The projector TV screen.
Yeah, it's probably not going to do it. Or the home theater room, like if you had a bunch of kids, like that is appealing to me, but I could totally appreciate if I was selling my home. We don't have a home theater room, by the way, but if I did, I think we would probably use it. But the expectation that the buyer is going to associate a lot of value with that for a room that they did not add and might not need, I think is a mistake that people make.
Yeah. And I mean, it's why when I think about my house, I do tend to think things in a very value conscious way. I look at a wall that needs painting and think like, tan or gray.
Yes.
Those are my options
Yeah,
here.
so it's like, can I paint this wall oatmeal? That's the
Yeah.
color that's in vogue right now. So
Cream.
yeah, and I think people are surprised to discover when real estate agents tell them, hey, yeah, you did a kitchen remodel, you might recoup 80% of what you put into that. You might recoup 90% if you do a bathroom or something like that. A little bit more utility.
I mean, and
there.
that's great. If you do your kitchen and I think you said that you put this in the outline, you lose 10%
Yeah.
as opposed to 30%,
Right.
or 40%
And I
in
think
that renovation.
with your framing, if you're talking about it within a context of an investment, it would be a little bit like saying, I've got a product I want to sell you for $50,000, and I can assure you, you will get no more than $45,000 back. And
Yeah.
you'd probably be like, I don't want to do that within that frame. But I think if we were being a little bit more fair about the investment, this is one that you get to live in. If your kitchen provides you a lot of utility, well then yeah, go ahead and do it because you have to live in the home. So I think when we're looking at the primary residence, maybe the theme of this episode will be viewing it as an investment is probably wrong right out of the gate.
Well, and also, if you're viewing it as an investment, what you should probably do is not live in it.
Right.
Frankly.
Yeah, because it would maintain its value
Yeah.
a
I mean, it's
lot
going to
better.
hold up a lot better. It's not going to have the wear and tear. And the insurance cost might be less
Might
if you're
be
not
less,
living in
and
it.
you probably wouldn't have to invest in so much like just ongoing maintenance, all the rest of that. And then,
Yeah.
but that was another good point that you made with the renovation and how much you would recoup. most of those estimates are very near term. So it's saying if you renovated your kitchen and then sold your home, you would probably recoup 90% of its costs. But if you renovated your kitchen and then continue to live in the house for another decade, it's quite likely that whatever you thought was in vogue at the time you redid it, the countertops you chose, maybe the color scheme that wasn't oatmeal, those might not be in vogue when you go to sell it. And so they're saying that that is on its own kind of, it's a depreciating asset. So the renovation of the kitchen you might capture 90% of that cost if you were to sell the home within a year. But if you were to sell the home within 3 or 4 or 5 years, it probably will dwindle down to 75% of the cost, 60% of the cost, something like that.
You're probably right. The one thing that is a little bit of a positive, though, and correct me if you disagree, but that is at least going to increase your basis in the house.
Yeah. So if it's a significant cost that will, I think that there are some kind of hurdles you have to jump through
Yes.
in order to qualify that as I guess it's a capital expenditure
improvement.
or a capital improvement and not just ongoing maintenance. That can be, included into the basis of the home. Now, the question is whether or not people will dutifully do that. When they're reporting the sale, I think that when we're talking with people, we encourage them to be very aggressive in that accounting. Because the worst case is the IRS just says you cannot include new gutters on the property. You cannot include whatever you did. But I think when you are going into a sale, and I know that the section, I guess it's the 121 exclusion amount, pretty high, $250,000 for a single, $500,000 for a married couple. And that's just the capital gain exclusion.
Yeah, if you've lived there for 3 years.
Yeah, 2 out of the last 5 years and whatever. There's some other hurdles you got to jump through too, but you're right. I think that we tend to encourage people to be aggressive in raising their basis because, again, that turns whatever portion of the return that you might get into tax-free return of principal. And then if you are frustrating that $500,000 line, it might help out a little bit there too.
Possible.
Yeah. But I think that there are some real benefits to homeownership too. And I think to make the podcast a little bit more two-sided, like you alluded to earlier, this is an investment you get to live in. So there you could, if you wanted to be coldly rational about what that would be worth, you could do an imputed rent. Essentially the rent you're not paying or the rent you could earn on the home if you were to rent it out to somebody. So
yeah, and I think it all depends on the lens that you want to look at these things through. Because I like to think of my house, frankly, as just not losing money. If I can do that, I feel okay about it. If the money that I would be putting into renting something is maybe recoupable at some point in the future when I do sell this house, I feel pretty good about that. I don't necessarily need to get a big return on it. And I think, that's just about perspective.
Yeah, and I think, again, if you're buying a property to live in, thinking it's going to be a wonderful financial investment, you're probably buying it in the wrong context.
I agree with you. And I think that you hear, I think in our society today, we hear about outliers. And, you hear about somebody who bought a house in California for $80,000 and now it's worth $5 million, or just the land itself is worth some crazy multiple of what they originally spent it on. But for most of us, it's going to arrive somewhere more in the middle.
Yeah. And then another note that I made was, and this is more, I think, pertinent for young people, is making your 30-year fully amortizing fixed rate mortgage payments, if that's what you have, it's what I happen to have, that really is a forced form of dollar cost averaging into an asset. So it's like, are there better asset classes? I noted here that long range estimates of how much real estate is appreciated on average are between like 5 and 7% at the height. So like we talked about before, if you were dollar cost averaging into just the broad market, would you do better over a long period of time? In most cases, yes.
Most cases.
But this is sort of a way that it's kind of like stealth savings. It's like you're building equity in your home. This is a non-recourse loan. It's never, your home's value is never marked to the market, and the bank is never going to give you a margin call on your loan. If the asset, their collateral has suddenly dropped in value a ton, they're not going to come to you and say, you got to post some more collateral. They're not going to do that. And it's a way for you to slowly but surely build equity when, as you and I have discussed before, the best indication of what a person will spend every month is what they earned. So this is another way that you can have forced savings and investing if you want to keep the lights on at your house and not have somebody show up and take it from you.
Yeah, and I think the longer you live someplace, the more you're going to be adjusted to that standard of living. So if you continue to earn more money and get raises over time and stay in that house, it's probably going to be good for your overall savings rate too.
Yeah.
If you're not hopping around every 2 years buying
Yeah.
something new.
And I was going to say, maybe something we could have talked about a little earlier is if you are intending on moving somewhere, but you're going to move again within a 5-year period, I think we talked about this on a previous episode, I would probably argue in favor of renting rather than buying because, like you talked about, the transactions costs on both sides are pretty steep.
Yeah, they are. And I mean, you never know what could happen with an asset that does have some standard deviation.
Uh-huh.
As much as people like to think that real estate tends to go up, say you're on a 3-year purchase and you buy at the top and then sell at a more difficult period, you're going to probably be lucky to break even when you take all the, your expenses out.
Yeah, and it's like you had to do the underwriting and you had to do the transactions costs, and then you're right, you bought a volatile asset, and I think part of the reason people feel like their home is their best investment is just because of purely that. They feel good about it because you're not constantly being solicited for a sale of the home at various and sundry values.
I agree. I think the other thing that's nice about home ownership and having a mortgage is it is the easiest debt for the average person to get. So if we want to think about ways that we can lever our asset base a little bit, most people are not going to do that with a collateral loan or a margin loan. They're going to do it with a mortgage.
Yeah.
So, and the other thing about the mortgage debt is it's pretty easy to refinance if rates comes down.
Yeah.
So I'm sure that, like, as we've talked about, you're probably
I'm itching.
anxiously awaiting interest rates to come down a little bit so that you can refinance and either get a little cash out or just pay a whole lot less on a monthly basis.
Absolutely. I cannot wait for the day. I'm not excited about the underwriting process, and I hate the fact that when you go to refinance a mortgage, they pull your credit, and that sends out I guess it's like a beacon in the sky, and everybody who's ever issued a mortgage calls you, and it's pretty wild for a while, but the savings are certainly going to be worth it.
Yeah.
And then I kind of glossed over a term that maybe not everyone is familiar with, what a non-recourse loan is.
Mm-hmm.
And what that means is if for whatever reason you were to get underwater on your mortgage, you can walk away from it and you are not personally liable for the balance of that. So it's like the bank can take the home, but that's all that they can take from you, which is kind of nice.
Yeah, that is nice.
And that's not true everywhere in the world. So part of the reason, like you said, it's a very accessible way to lever investments. That non-recourse provision in the mortgage is not primarily responsible for that, but it's a huge part of it.
Well, and I think that that's also why, and I've run into this before, it's where you can get really hung up on inspection and not hitting the appraisal number.
Uh-huh.
When you look to either buy or sell a house, because it's non-recourse.
Uh-huh.
If they had recourse, the bank probably wouldn't care if it appraises for what you want to buy it for.
Yeah, I mean they would. Yeah, I mean they would certainly have less of a dog in that fight.
Yeah, they'd have less of a dog in the fight.
Yeah. And then the other thing that I thought we might talk about was a lot of people they're aware of the 60/40. We've done a whole episode on the 60/40 about how it's not dead. It was just hired to do the wrong job and all that. I think it's still a viable way of investing, notwithstanding what happened in 2022. I don't think that the 60/40 is dead. But a popular spin on the 60/40 has been the 60/30/10.
Mm-hmm.
So the 60/30/10, 60% stock, 30% more traditional fixed income, and then 10% alternative investments.
I've also seen a 50/30/20.
Okay, wow.
Yeah,
The 20 being the alts?
Yeah, some
Okay.
people like it.
Well, I mean, I think that might lend itself to what I'm about to say here is most clients see the 60/30/10 and they immediately think, oh, I need to go out and buy with my financial assets, my portfolio, a 10% sleeve in alts. So this could be like managed futures or, as Richard likes to joke, a pile of gravel, because that's just a commodity. It could be gold, or it could be something that, they're looking for. And that we actually joked with the client. Most times they're looking for an asset that goes up when the market goes up, but doesn't go down when the market goes down.
Mm-hmm.
Not really how alternative investments work. That's not really what they're going to provide for your portfolio. However, the literature that I reviewed, and I'm sure you reviewed in the CFP study and the CFA study, would indicate that risk-adjusted returns are slightly better with that 60/30/10, and I'm venturing the 50/30/20 kind of model. But as I included in the note to you on this episode, very academic, and I don't think that's really the way people would consider it. And lastly, they fail to recognize that their home probably meets that threshold already.
I think you're probably right. And I think that also, I don't have the scientific data to back this up, but I feel like we just keep hearing more and more about how in the new age that we are in this new market, that correlations converge in
Mhm.
times of stress. And if we look at a 50-year swath of time to determine that the 50-30-20 did better on a risk adjusted basis, but the last two times it didn't,
Yeah.
I'm not sure how much it helps you to be
Yeah,
in that.
that presupposes that there is going to be kind of an indelible relationship between the past and the future.
Hmm.
And it does make presentations, and typically, and this is really not to take in, I'm not taking a shot at these people, but most of the
I am.
time, but I would say most of the time, you hear the data on how well on a risk adjusted basis this 50-30-20 allocation or the 60-30-10 allocation has done is by a seller of, in most instances, a very expensive private credit or private debt or infrastructure
Fund of
fund of
funds.
funds, or a hedge fund person, or a somebody who's offering something in the alternative space. They're typically using this as evidence for why you should buy their product. And when we have conversations with clients about those products, when we allude to their home as providing them that sort of orthogonal exposure that they're supposedly looking for, it seems like a light goes on. Or they are like, oh, yeah, I do have real estate, but I don't really include that as part of my portfolio. And it's like, but you should, because it's providing you that sort of orthogonal, risk return profile that you're looking for, and you don't have to do anything.
Yeah, and I think that this is the same thought process that goes into another phenomenon that we've talked about, which is really popular in the FinTalk sphere right
Uh-huh.
now, which is the, oh, you're selling your house, you should become a landlord and don't
Right.
even consider, selling the house and investing in the market. And I think all of these thought process are is big real estate
Right.
behind this. I'm not sure.
Yeah, it's. I feel like the most recent boogeymen are BlackRock, just as an institution. Like they're
Yes.
buying up all the houses, and it's like, okay. And then there's also private equity. People think
Yeah.
like private equity is just going to consume the world, and it's like, all right, I don't know much about that, but I think for your typical retail investor, if you've got a 60-40 already, and then you reallocated your portfolio to include the value of your primary residence, yes, it's not paying you any cash flow, but it is worth something, and it will appreciate, I think, long term, 5 to 7% over time. And because it isn't marked to the market, it's probably going to provide you some semblance of stability when the market generally feels a little bit wild. Now, if you were to immediately try to sell it in an economic nadir, you wouldn't get your asking price in
That's
most
true.
cases. So probably, like you said, correlation collapse, I think, is a big problem. Maybe it's algorithmic trading. I don't know exactly the cause of that, but your real estate isn't going to be totally insulated from correlation collapse. But again, I think if most people were to consider their property as part of their financial portfolio just for this one reason, not necessarily as something that they are viewing as an investment, but I think it would allow them to feel like, okay, my total return is a little bit less volatile than it is just in my stocks or in my bonds or with those two combined.
Yeah, I think that that's definitely right.
And then I thought one of the jokes I made in the note I sent you was pretty good, where you do get to live in this asset, whereas you can't cozy up in a bond fund on a cold winter night,
No, you definitely can't.
But I don't know, Scott. Do you have anything to add on the conversation regarding your home as a, I guess your home as an investment?
Yeah, the last thing that just popped into my head a second ago was, like so many things, I think some people can feel like, all right, well, this, you were talking about the forced investment aspect
Uh-huh.
of home ownership a little bit earlier. But what I'll tell you is that sometimes we see situations where people who maybe have that spending discipline problem,
Uh-huh.
we go to look at the plan and they've got a whole bunch of loans against the 401k plan or or their personal mortgage in a home equity line of credit, or
Uh-huh.
they've taken a bunch of cash out of the house. I think that it probably goes down to your best results are going to come through discipline,
Mhm.
whether it's, just continuing to pay the mortgage every month, not accessing your, your equity. If you say get a big increase in the price of the house, and kind of boring home ownership, frankly.
Yeah. And I think if I had to close on something, it would be that this episode is not at all intended to dissuade young people from home ownership.
Not at all.
Not at all. And I think, we've talked about, internally doing an episode on the rent versus buy, but I feel like that conversation is so fraught now, where people are so tied to one opinion or the other, that you and I just haven't really touched it. So this is not our attempt to sort of come in there and just say, hey, implicitly we're on the side of rent. I own a home, you own a home. I think it really is a wonderful thing to have. I think that it's very, an important piece of a person's maturity is to own property. And I think that owning the dirt underneath your feet conveys a certain sense of, I don't know, status, I suppose.
It's
and that's
the American dream.
right. And it's not to say that if you haven't owned a home yet that you're not doing what you should be doing. I'm sure your situation calls for that. But this isn't an episode telling young people or anybody, don't own a home. This is just saying, when you do decide to buy a home, make sure that you're purchasing it in the appropriate context and you're not agonizing over whether or not everything you do there will be a good financial investment.
I agree. And that you don't expect it to outperform tech stocks. Expect it to do something positively over time in a good scenario, but don't expect it to light the world on fire.
There we go.
Thanks for listening. If you enjoyed this content, go ahead and give us a like or subscribe. Follow us on Apple Podcasts, Spotify, or YouTube.
Thank you for listening to another episode of the Personal Finance Project. This show would not exist without the help of our brilliant creative director, Kira Minifield. Kira, thank you for everything you do to keep this show running. On to the disclosures. This broadcast contains the current opinions of the hosts and are subject to change. The broadcast is provided for informational purposes only and should not be considered investment advice or recommendations. Investors should obtain professional advice before making investment decisions. This is not a complete analysis of every material fact regarding any company, industry, or security. The information has been obtained from sources we consider to be reliable but cannot guarantee their accuracy. Robert W. Baird & Co. Incorporated is not a legal or tax services provider, and you are strongly encouraged to seek the advice of the appropriate professional advisors before taking any action. For more information about any companies discussed, please contact Baird. Past performance is not indicative of future results, and diversification does not ensure a profit or protect against loss. All investments carry some level of risk, including loss of principal. An investment cannot be made directly in an index. Investors should consider the investment objectives, risks, charges, and expenses of a fund carefully before investing. This and other information is found in the prospectus and summary prospectus. For a prospectus, please contact your financial professional and read it carefully before investing. Annuities carry unique risks, including market risk, investment risk, and claims-paying abilities of the insurer. There may also be instances where a contract will pay out less than the premiums paid or expire within the lifetime of the insured. There may be penalties for early withdrawal, and they are not insured by the FDIC because they are insurance, not an investment. Investors should consider carefully information contained in the prospectus or, if available, the summary prospectus, including investment objectives, risks, charges, and expenses. You can request a prospectus by reaching out to your financial advisor. Please read the prospectus carefully before investing. Investment returns will fluctuate and are subject to market volatility, so that an investor's shares, when redeemed or sold, may be worth more or less than their original cost. Unlike mutual funds, shares of ETFs are not individually redeemable directly with the ETF. Shares of ETFs are bought and sold at market price, which may be higher or lower than the net asset value, NAV. Baird does not issue or underwrite mortgages and does not service mortgage lending services. Any references to mortgages in the financial services offerings are purely intended to convey an engagement in this holistic planning process, with this as one piece of the larger picture, which may or may not apply to all clients. This broadcast may not be reproduced without express permission of Robert W. Baird & Co. Incorporated.